is needed instantly. Intangibles, such as software, information, services, and most recently, human capital, have replaced hard goods, mass, as the most valuable and fastest-growing part of the economy. These three principles define the connected economy. Speed. Constant change is healthier than stability. Connectivity. Open systems thrive, closed ones wither. Intangibles. The virtual trumps the physical. In their previous book, Blur, the authors wrote that the production and consumption of goods and services, what economists call the real dimension of the economy, was changing to reflect these principles. In future wealth, we turn to the financial side of the economy. Don't confuse this with the financial services industry, with its banks, brokerages, and insurance companies, although this sector will be profoundly affected. We focus here on the financial aspects of all people, business, and society. We're accustomed to the financial aspects of business. Today, however, as connectivity proliferates, anyone can trade anything of value electronically. Soon, every individual will participate in finance, defined as trading risk, as both trader and tradee. The definition of wealth remains, as always, the means by which we fulfill our desires. As the saying goes, you are wealthy if you want no more than what you have, whether you grasp for fame, fortune, friends, or followers. In economic terms, this translates into material possessions and the means to attain them. In social and political terms, it translates into greater freedoms and the means to attain them. To fare well, we need a new mindset for the way we work and earn, spend and save, plan our mortgages, taxes, and investments, and take responsibility for our own development. This holds equally for individuals, companies, and societies. Wealth has a life cycle. It is created and accumulated. Then it is distributed, whether through taxation, dividends, or inheritance. At any moment, we can take a snapshot of where wealth is being controlled. Each of these aspects of wealth is mutating. While the real economy creates wealth by producing goods and services, the financial dimension does so by bearing, trading, and managing risks. This difference is enormous. For individuals, it's the difference between our labor, real, and our investments, financial. People accumulate real wealth through both their tangible possessions, such as cars, houses, and furnishings, and their intangible ones, such as their knowledge and relationships. But they build financial wealth, their net worth, by bearing risks in their 401ks and investment portfolios. Every asset has a value, and every value is at risk. Many of us sell one home and buy another, recognizing that every piece of real estate has both upside and downside financial risk. Few actively set about trading houses as a way to make profits. More of us, however, are borrowing against our homes in order to trade financial assets based on our judgment of whether they'll rise or fall in value. In other words, we trade risk. For companies, we're discussing the difference between the products and services they offer, real, and the cash flows they generate, financial. Real wealth lies in tangibles, such as factories, and in intangibles, such as customer relationships. But if you want to see a company's financial worth, then look at its share price. That's what companies themselves do, and that's why they put so much effort into financial engineering, massaging earnings, and so forth, to keep analysts enthusiastic and investors bullish. And for societies, it's the difference between the GDPs growing annually by 3%, real, and the Dow Jones Industrial Averages growing, or shrinking, by 20%. It's also the difference between the quality of a society's infrastructure, its roads, hospitals, and the like, and its borrowing capacities and currency reserves. In all three domains, making money is starting to be as important as making stuff. Money takes on a life of its own. As we've seen in recent history, currency crises can drive the real economy into sharp recessions, as in Mexico, Thailand, Malaysia, and Indonesia. Businesses can be similarly constrained by their liquidity, and individuals save or consume depending on their own investment performance, as well as their appetites for risk. Traditionally, most economists have considered the real sector primary and the financial sector secondary. In August 1999, this perspective reversed, as Federal Reserve Chairman Alan Greenspan explained to Congress. Here's how the New York Times reported Greenspan's testimony. "We no longer have the luxury to look primarily to the flow of goods and services when making decisions about interest rates," Mr. Greenspan said. In effect, he was labeling what he called the extraordinary increase in stock prices over the past 5 years as one of the major economic forces capable of pushing up the inflation rate. Traditionally, a run-up in stock prices has been viewed as reflecting a strong economy and profitable companies. The economy drove the market. Now, the opposite is more and more the case, Mr. Greenspan suggested. In other words, as we create the connected economy, the economic action, the accumulation of wealth, is shifting from the real economy to the financial for two main reasons. In the short term, investors perceive the connected economy as an extraordinary opportunity to create real future value and are buying into it, bidding up the stock market and creating current financial wealth. There is undoubtedly some inflation of asset values, but the financial markets are correctly recognizing growth opportunities. The rate of growth in value may be temporary, but not the billions of dollars of market capitalization, which will ultimately be sustained by the continuing creation of value in the real sector. Longer term, the information economy's form of capital, information, knowledge, and talent, can be leveraged indefinitely at much lower costs than can the financial capital needed to build steel mills in the industrial age. The amount of financial capital required is much smaller, which is lowering the amount of capital needed, and thus its cost. And unlike a factory, information's capacity is almost unlimited. The wealth from movies or computer games comes from almost pure margin, as more and more people use them, a phenomenon often called increasing returns. The connected economy is built on increasing returns businesses, software most of all, and therefore takes less physical capital to produce a given quantity of economic value. This is one way the economy becomes intangible. Microsoft's sales to physical assets ratio is 12.26, whereas U.S. Steel's is now only 1.96. This means that financial capital is becoming less scarce, the cost of capital is falling, and the price of entry to new businesses is lower. These factors will continue to hold true, whatever the fate of the Internet stock run-up. So don't dismiss them, even if by the time you hear this, price-earnings ratios are depressed. To be an entrepreneur, you won't have to create a low-risk business plan to get a lot of money. You can create a high-risk one and fund it yourself, or with a friend. The ease of raising the required cash, or of self-funding new ventures, in turn will change the distribution of wealth in society. Almost all of us know how much we make, income, but it's only a slight exaggeration to say that almost none of us know our net worth. Those who have inherited wealth, and the financially enlightened few, understand the important difference between income and net worth. They focus on the latter and make it work for them. What they earn directly is not their primary financial concern. Not too long ago, A lawyer brought this home by saying, "No matter how much or little you make, it's still only walking around money." The statement is both arrogant and accurate. His remark underscores the increased importance of unearned income and its growing contribution to people's accumulation of net worth. Earned income consists of the salaries, wages, and tips you work for. Unearned income is the additional wealth created by putting your assets to work for you. The more that wealth accumulates in the form of financial assets, and the more those shares and other securities appreciate in value, the more wealth is created, not as earned, but as unearned income. Unearned income from interest, dividends, capital gains, pensions, and annuities has become steadily more important to U.S. households. For every dollar made in earned income in 1975, that is, taxable income earned from wages, businesses, and unemployment insurance, U.S. households got 13 cents in unearned income. By 1997, this figure almost doubled to 25 cents. As wealth becomes more liquid and takes the form of financial rather than real assets, the middle-class appetite for risk is growing. The more unearned income that people make, the more risk they are bearing. In 1990, investors placed $44 billion in new money into mutual funds. In 1998, the figure reached $477 billion. According to the Wall Street Journal, 80 million Americans, or 52% of households, own investments. Paychecks will always matter. Bull markets come to an end, financial bubbles burst, and periods of poor stock market performance interrupt the growth of unearned income. But the data suggest an irreversible trend. The source of financial wealth is shifting from money that you work for toward money that works for you. Unearned income is growing, and more people have it. Wealth is becoming middle class. By middle class, we mean individuals and households not rich enough to live without working, but with enough income to save regularly. Years ago, we might have called them well-to-do. Today, the sustained boom in the United States has moved some poorer families into this category, though the distance between the richest and the poorest continues to grow. In our discussion, what matters most is not the gap, but the proportion of the society we can call middle class and above. As society as a whole gets richer, people will benefit more from the wealth they previously accumulated, and will depend less on their current wealth creation. This feeds on itself. When wealth grows faster than income, unearned income is an ever larger proportion of total income. To ride this trend, you must appreciate net worth as the source of wealth, not merely the outcome. The control of wealth is tilting from institutions to individuals. In early industrial times, control of wealth moved from the few landowners to the robber barons who controlled the new scarce resource, credit. In the late industrial era, managers controlled corporate wealth without owning it. Then, the rapid growth of retirement plans and the crunching power of computers made employee pension funds major controllers of the economy's wealth. Still, neither the employees, those who owned the plans and for whose benefit the pension funds operated, nor the unions, those who helped workers gain their retirement benefits, gained control of the wealth. Instead, control went to the financial analysts who advised the plans and the fund managers who ran them. With 4 distinct economic periods, late agrarian, early and late industrial, and early information, we have had 4 different groups in control of the nation's wealth, from landed gentry, to owners, to managers, to pension funds. Now, with the democratization of financial information, individuals are taking more responsibility for managing their own wealth. The power